If you want,
or if you want, I
you
can
can present
start.
first. Yeah, yeah, you prefer present first. No.
All right. So let me start with my paper, and I will ask Alexander, please, to check the time, and don't let me talk for more than 12, 15 minutes at the most.
Okay, 12 minutes max.
Can you do that for me?
Yes, of course. I can do it.
All right. Thank you. So let me get my paper here, and then all right. So can you see my paper?
Yes.
Yes. All right. So as you know, you can double click the, and you can see it bigger, a little bit bigger. All right. So well, this is our paper, Determinants of Corporate Tone in the Initial Public Offering, Powerful CEOs versus Well-Functioning Boards. This is a joint work with Alexander Guzman, Maria Andrea, that is right in there, and Diego Telles. This is also here. So this is the full responsibility of all the four of us. So basically, in a nutshell, what we study in this case is how we study the factors that shape the tone in the information disclosed in the IPO prospectus. We are using 193 Latin American IPOs during the 2000-2014 period. So we have three main results. The first, that powerful CEO avoid unfavorable tone, which we may expect. However, as we will argue, when the CEO have a risk of losing their job, they will be more over optimistic in order to get a successful IPO. Our second result, we also show that boards that are more independent tend to use more unfavorable tone to reveal information to the investor, to have more accurate information, and somehow counterbalance the over optimism of the CEO. And third, we find a non-monotonic relationship between the board size and the tone of the prospectus, suggesting an optimal board size that mitigates excessive use of positive tone and leads to use more unfavorable tone in the IPO prospectus. So overall, well-functioning boards somehow counterbalance powerful CEO, generating a more realistic disclosure to the market. Our main motivation, there are a few papers that posit the importance of tone. We have actually the same group, of this paper, two other papers that study the impact of tone in different things. For example, firm value, IPO underpricing, and so on. However, there are not many papers that study the determinants of the tone. All right, so this is our main motivation. Because some don't have too much time to discuss in much detail the hypothesis, I be very quick. We have basically three hypotheses. The first, we argue that powerful, entrenched CEOs tend to use over-optimistic tone in the IPO prospectus. As powerful CEO, we mean CEO that is also the chairman of the board. So as we said before, all CEOs want to talk good things about their IPOs, right? However, what we said, what we posit in this hypothesis is that the market discipline could put at risk the CEO for unsuccessful IPO. And therefore, this powerful, entrenched CEO will tend to be over-optimistic. This is basically what we argue. The second hypothesis is that boards that are more independent tend to avoid this over-optimistic tone of the IPO prospectus. Of course, they care about their reputation. They somehow constrain this managerial opportunism, following the literature. And they also provide stated guidance. So we think that independent boards will impact this information or the tone in the information disclosed to the market. And third and last, we argue that there is an optimal board size that makes firms more effective in avoiding over-optimistic tone in the IPO prospectus. So more or less, the argument is that small board, they may lack of enough experience and diversity on the one hand, right? But on the other hand, large board, too big boards are too big, could suffer of coordination and free riding problems. So it seems that there is an optimal board size. All right, so this is our data set. Basically, we study, as I said before, 193 prospectuses in these 5 Latin American countries. The prospectus, this is the usual structure of the prospectus. We, following the literature, focus our attention in 2 sections: the company summary and the risk factor section. This, we believe, as other researchers in this literature, that these 2 sections are the ones that generate more information. All right, so we took all this prospectus. We follow a process called tokenizing the summary and the risk factor section, and then this is basically cleaning up and getting only the words without anything else. And we found an average of 495 words in the summary section and 217 in the risk factor section. And then we follow a process that we explain in other 2 papers actually, that we make a translation of the dictionaries proposed by Logren and McDonald. We follow a very detailed process of translating these English words into Spanish and Portuguese. And we divide our sample in unfavorable tone, favorable tone. The unfavorable tone summarize what Logren and McDonald categorize as weak moral, negative, and uncertain words in their dictionaries. These are some examples of the words, the most used words in the IPOs. Here in the Portuguese and the Spanish. For example, in the summary section, aproximadamente was the most frequent word in Spanish, and in the summary section, and podría was the most frequent word in the risk factor section. All right, this is our model. Basically, we measure we have this tone measure that's going to be positive or unfavorable, controlling for governance variables, control variables, firm-specific, just financial specific variables for the firms, and also the context variables, market capitalization of the country, and of course we have a dummy variable controlling for the Brazilian's IPOs. Very quickly, you can put this a little bit bigger if you want. These are our main results. When we look at the positive tone measures, we found positive and significant in all the models. The models basically are when we control for crisis dummy, if the 2007 financial crisis, the Brazilian dummy right here in the third model, and also the market capitalization. So in here, basically what we found in these positive coefficients is that powerful, entrenched CEOs tend to use an overly optimistic tone and IPO prospectus. We argue that This is because the unsuccessful IPO will increase the probability of their dismissal and lose of their private benefit of control. It's more or less what we argue in the hypothesis 1. Then when we look at the board size, we found a negative relationship. So bigger boards could have more capacity to supervise the CEO and somehow counterbalance the tendency to use excessive positive words. But as you see here, there is a non-monotonic effect. The board size square has a positive sign. So that is true until certain point. In the model 1, this certain point is a board around 11 members. Following the positive tone, we found no significant effect in the variable of board independence, meaning that board independence has not significant impact in the positiveness of the prospectus summary. When we go to the negative words, unfavorable tone, we found, as expected, a negative and somehow significant sign, meaning that powerful, entrenched CEOs will be unwilling to put forward unfavorable words. The sign of the board size reversed, so the reputational effect of the board will encourage their directors to put their firms in a more balanced position, avoiding an over-optimistic view of the firm. But again, this relationship is not monotonic, so that will be true until certain point. And finally, when we look at and this is a really nice result, when we look at negative unfavorable tone, we see a very high and significant positive coefficient for board independence. So we argue that this result could be regarded as the independent director's influence in curbing misleading information by the CEO and offering the market a more realistic assessment of the IPO. So we just summarize this saying that we find empirical evidence of the influence of the powerful CEO in avoiding unfavorable tone and fostering the use of positive words in the information disclosed to the market, this over-optimistic story. But we also show that boards that are more independent tend to use more unfavorable tone, so somehow counterbalance this over-optimism. And finally, and we also think that is a very nice result, we find a non-monotonic relationship between the board size and the tone of the prospectus, suggesting an optimal board size that mitigates excessive use of positive tone and lead to the use of more unfavorable tone in the IPO prospectus. So the size of the board for these IPO firms matters in that sense. And well, this is basically it. So thank you very much for your attention. So let's ask the chair, that is now Alex, if I have some time for questions or comments.
Yes, you have. You spent 13 minutes in your presentation.
13, all right. So good. So I don't know if there's somebody else, because when we are presenting, we don't see the people in the room. So I think we're still the same. We have Mauricio and Urbi. So well, I think the rest knows the paper very well. So basically, let's hear Mauricio and maybe Urbi have some questions. Yes, Mauricio.
Yeah. Congrats for your paper. It's a very good paper, I guess. And I have two questions. You all include IPO firms, no? That was executed. This is your sample.
These are IPO prospectus. Yes.
Only prospectus. Yeah,
These are the IPO prospectus. Yes. I don't know, Diego. Maybe Diego can answer that. I don't know if all of this IPO prospectus end in the actual IPO issue. I don't know. We have this information, do we, Diego?
Yes, Max. Yes, actually, all those are we're finally in the market, and even for some extensions of this work, maybe we are considering the fact that some of those IPOs after some time were delisted from the market. But originally, the ones we have there in the paper were in that moment active in the market.
Okay, but the data that you use is in a panel, that data, no?
No, actually, we have like it's a pool regression because we have for every single IPO, we have all the information concerning the offer itself and some fundamentals from each company at the moment it went.
Additions, yeah, okay. No, yes, I'm only asking because there are some papers that state that like a counterfactual. Those IPO which was withdrawal, Bernstein of your Journal of Finance offers a methodology to try to compute some endogeneity problems, but this is not the case,
Mm-hmm.
That's all. Congratulations for your paper.
Thank you, Mauricio. Thank you very much. All right, so I don't know if we had some questions or comments.
No, I want, yes, I like the paper. And,
can you open the camera? Can I see you?
let's
Can I
see.
see you, please? Thank you.
Okay.
Yes.
Yeah, I like the paper, and I would like to read it more calmly. It's somebody else is asking for the paper on the chat, by the way. So
Yes.
if you can send the paper. So just, one question: whenever you see, you have the paper like this, and what has something similar to this has been conducted in the U.S. or where you have so many IPOs? Because in Latin America you don't have that many, compared to the U.S.
Mm-hmm.
And what's the difference? What's helpful in Latin America to conduct your research instead of doing it in doing this question for the U.S.?
Yes, actually, in the U.S., of course, the IPO literature is huge.
Yeah.
There is a lot of papers regarding IPO underpricing. By the way, actually, we have one paper that we follow this same line and see how tone is influence the IPO underpricing in Latin America. Of course, that had been done for Logan and McDonald's in the U.S. However, as far as I know, maybe Alexander and Andrea can help me with this, but as far as I know, there is no determinant paper for the IPO tone. So that's what makes this paper very nice, because actually, as I mentioned before, the tone is being regarded as a very important factor for IPOs, as one would expect. But it seems that nobody has asked what determines the tone. Maybe because this literature is quite recent. Actually, the Douglas and McDonald's papers are 2000 and what, Alex?
2011 and 2013.
2011 and 13. So they are not that. There are not too many papers on the relationship between tone and IPO. All right. Thank you, Luis. So I will send you the paper, and
Okay.
We're more than happy to receive further comments from you.
Okay.
Mauricio, also, if you want, I can send you the paper to read it more carefully.
Okay, thank you.
All right, good. All right, so let's now go to the Mauricio's paper. He's presenting together with Juan Pablo Torres and Sergio Lavarrieta, Family Firms, Contestability of Control and financial constraints, evidence from Latin America.
How can I share my screen? I don't find that.
All right, so you have to go first. You need to click where the computer.
Yeah, I'm doing that, but.
And then on the top, you will find. Are you using Chrome?
Yeah, no,
Yes.
Firefox, I guess.
All right, so on the top, you should see something that is said Vista Aplicación. And the top, Vista Aplicación, and then you click there, and then you will find you will find your presentation there. So when you click,
it's not in the top. It's in the bottom. In this case,
all right, maybe because of the Firefox. Yes, maybe that is the reason.
I will.
Chiquita. No. No. Are you with us, Mauricio? Let me see if Mauricio is having. Can you hear us? Oh, I think we lost Mauricio.
Yes.
Nelson Andrade, hello Mauricio, we're not seeing you. Hi Nelson. So yes, I don't know what happened with Mauricio. All right, so at least it's in here. Oh, hello. Hi Nelson. No. Hi. How are you, Nelson?
Mauricio, we are not listening to you, and maybe your video is not working neither. So,
but it was working a minute ago.
Yes,
so.
But it could be because of the browser. If you can.
Yes, I think the best thing is to go to Chrome. I hate Chrome. I never use Chrome, but it works very good in this. It works very good in here. So I think you better, Mauricio, go to Chrome.
Yes.
All right. So I think he's doing that. So Nelson, are you presenting a paper? You already present your papers in the PhD, right?
Yes, I already presented in the doctoral colloquium in May this year. Yeah. I presented my paper and I received nice feedback.
Actually, Diego Telles, the one you see there, I don't know why they don't show their camera. Diego, Alexander, and Maria Andrea, they were my former PhD students.
Oh, great.
Yes, yes. Why you say that, Alexander? Yes.
Hard
Maybe
experience.
he's remember for all the things you have passing through now. And
Hi,
Diego,
Diego. Nice
So-
meeting you.
yes.
But it was a good experience, or not? Diego?
They will say yes because I'm here. I don't know if I'm not here. What will they say? All right, let's wait, Mauricio. Well, we don't have the other paper, so there is a non-show. Camila, are you with us?
Of course.
Yes, Camila. In the other session, you were assisting this morning. There were other non-show papers that just didn't.
No, everyone arrives.
Everybody was in there, right? Yeah.
And it happened in one session, but we have to wait because we're having this kind of problems with connections, and
Yeah,
so
it's too bad. Yes, too bad.
that's true.
Yes, Alexander is saying there that it was a great experience having. Let me take a picture of this to recall him sometime. And Alexander and Maria Andrea. So Diego, I don't see Diego writing anything. It was not that a great of experience for Diego, I guess. No, it was fun. Actually, we have now another PhD student, but it's just in the beginning, just looking for. Oh, here we have
Yeah.
Mauricio again.
You hear me right
Mauricio.
now? My
Yes.
advisor, Max.
Hi,
All right.
Mauricio. How are you?
Hola, Nelson. Hi, Nelson. How are you? Fine.
Fine.
Where are you?
Okay.
In
Please
Colombia
continue.
or here in Chile?
No, I am here. Yeah, in Chile. Yes. Okay. So please continue and.
Yes.
Well,
Did you move
my paper is not that so sophisticated as Maximiliano's paper. I will try to present it. I will open the.
So did you move to Chrome, Mauricio?
See, yeah.
Yes. So you have to click what Vista Aplicación, I think.
Here I
It is
get.
called.
Have you seen the?
Exactly. Yes. We are seeing
Yeah.
now. All right. Perfect. So you will have like I will guess like 15 minutes because we still have time. So.
Okay, don't worry. I don't see anything, but I will try to speak a little bit about the paper.
But yes, but you can see your own presentation, right, or not? So you should click in there, I think.
But you see the whole presentation? I guess yes. No.
Yes, I see it. I see it.
Yeah. Okay. Well.
But you can double click your presentation, Mauricio, and it will.
No, because
I
saw it in the full screen here in my monitor, my screen.
Yeah, we can see the presentation.
Well, my name is Mauricio Jara. I'm a professor of finance of University of Chile. My co-authors are Juan Pablo Torres and Sergio Lavarrieta. This paper is a little bit old paper that is entitled Family Firms, Contestability of the Control and Financial Constraints, Evidence from Latin America. The motivation of this paper and the main objective of this paper is to analyze the link between family firms, multiple large shareholders, and investment cash flow sensitivity as a measure of financial constraints, and then try to answer some questions related to how multiple large shareholders and contestability to the control moderates the effect of financial constraints of family firms, or the relationship between cash flow and family. Well, the motivation of this paper rely on the Modigliani Miller, who state that under perfect capital market, there is no financial constraints, so there's irrelevance between which kind of source of funds you can pick up to satisfy investment opportunities. When we have some kind of financial frictions, can lead to agency problems, especially in Latin markets. That can lead some problems, agency problems that can be represented some kind of suboptimal of investment policies, like overinvestment and underinvestment problems. Both leads to dependence of more internal cash flows generated. So cash flow from operations or internal generated becomes relevant to explain some investment decisions more than as well as investment opportunity set. Financial constraints arise from the wedge of cost between internal and external funds. We suppose that the more financially constrained are firms, the wedge of cost is higher. Yeah, and firms will depend more from internally generated cash flows to satisfy investment opportunities. So we can expect that firms that are more financially constrained will present more sensitivity of cash flow to investment. We try to link in this paper stem or arguments main and agency problems. We try to read to family firms because family firms is a special kind of controller shareholders in Latin America, and also because there are some kind of interaction between family shareholders. Some features that can present some advantage from family firms are the fact that they invest in the long term, you know. They can engage too in monitoring activities in firms that are not controlled, and also they're firms that are non-family owned. Yeah. And finally, the literature has found that higher ownership concentrations reduce divergence of interest between insiders and outsiders, and promote some optical resource allocation, especially in those countries that present some kind of weaker legal enforcement and legal protection to the outside investors. So family firms can constitute a corporate governance mechanism that of convergence of interest between insiders and outsiders. On the other side, family shareholders present some drawbacks. These drawbacks are referred to that several family firms tend to collude. Can form some control coalitions to get the power of the firm and create ownership structures and that can result in expropriation activities, especially here in Latin America, where complex ownership structure are the most common structure to get the control of the firm, such as pyramidal structures or cross holding configurations. And other arguments are related that when family get the control, they tend to avoid monitoring. They get the control to avoid monitoring in some cases. We do not stem this paper and other motivations, but there are some other argument that can explain the relationship. I guess that can explain the relationship between financial constraint and family firms as SOU, EUW, and resource-based view approach. In this paper, we also examine the role of contestability to the control in reduced agency problems. Contestability to the control is defined as the ability of the other large shareholders to monitoring the largest shareholder or to challenge this power. Well, we expect a dual effect regarding the contestability, the presence of contestability. The first one is related that the contestability could result in a convergence of interest between various shareholders. But on the other side, when family has the control, family can be reluctant to be monitored, especially when they have the undisputed control. That is common that some families have the absolute control of firms. Well, as we hypothesize that family firms in this paper, that family firms could reduce financial constraints, contestability to the control, reduce financial constraint on average for the total sample. Contestability to the control increased investment cash flow sensitivity relationship in family firms. That is consistent with the arguments that they avoid monitoring to be monitored. And the existence of family secondary large shareholders increased the investment cash flow sensitivity relationship in family firms in the line with colluding arguments. We select a sample of firms that belongs to 5 LATAM countries, such as Argentina, Brazil, Chile, Colombia, Mexico, and Peru. Are 6. Our final sample are 449 family-controlled firms. 449 firms are not family-controlled. Family-controlled and non-family-controlled firms, and 4,034 observations. That includes family and non-family-owned firms. The financial information that we collect are based on Reuters Acon. Some accounts we obtained was obtained from Capital IQ, and some characteristics of some features of shareholders was hand collected from web sources. The empirical model, well, the dependent variables is investment. We introduce cash flow to compute the cash flow sensitivity of investment as a measure of financial constraint. We expect that beta 1 is higher when financial constraint is higher. And then we include some interactions. Cash flow is interacted with family, beta 2. With contestability in beta 3, and we introduce a triple interaction in beta 4, family and contestability, or the existence of multiple large shareholders, in order to assess the influence of the existence of multiple large shareholders or contestability measures on the relationship between family firms and cash flow. In this sense, we try to find if contestability or multiple large shareholders moderates the relationship between financial constraint in family firms. We perform some OLS regressions, introduce some set of country years, interacted country year fixed effect, and we also control all of regression by firm fixed effect. We also, but I don't show this robustness check in this in the presentation for time concerns. We also perform some robustness check by using GMM estimations. Our main results suggest that family firms reduce financial constraints. Many family firms can proceed as, I don't know, corporate governance mechanism that reduce the agency problems on investment. And this relationship is captured by beta 2. If you see beta 2 here, the relationship, the sensitivity to the catch to investment is reduced, and approximately 8%. If we compute the marginal effect between beta 2 and beta 1 and beta 2, the marginal effect is positive and statistically significant. That indicates that family firms reduce financial constraints. If we look around the number of family block holders as a measure of the existence of multiple large shareholders, we observe that family firms reduce financial constraints, but when family shareholders, when in family firms, the number of when firms has more block holders, family block holders, this relationship is attenuated by the number of block holders. That means that the beneficial role of family in reduced financial constraints or investment cash flow sensitivity is also attenuated by the presence of multiple large shareholders. That can be a signal, or this give some lights about the colluding arguments that we posit in previous hypotheses. As conclusion of this table, we find that the existence of several unrelated family large shareholders partially increase financial constraints and family firms. Well, if when we analyze the contestability variable measured as the sum of second, third, and fourth large shareholders over the first, the ownership of the first large shareholder, we find that contestability, in order to other previous studies, reduce financial constraint. It's a mechanism that give an effector monitor to this kind of effective monitor to some or reducing some agency problems. But contestability also play another effect on family firms. We observed that family firms reduce financial constraint, but this beneficial role of family firms over financial constraints is reduced by the existence of by higher contestability. Well, if we look for the marginal effects, we can find that contestability reduce financial constraint, but in family firm is increased. So, as a conclusion of this this table, we find that the contestability reduce financial constraint in total sample, but increase financial constraint in family firms. As a conclusion, well, very simple. We find that family firms reduce financial constraints. The existence of multiple large shareholders reduce the investment cash flow sensitivity as a measure in non-family firms, and increase the investment cash flow sensitivity in family firms. We also find a dual effect of contestability on financial constraints, similar to the previous using the multiple large shareholder measures. Contestability reduced financial constraint are going to monitoring arguments, And contestability increased financial constraints in family firms, in line with the arguments that family firms avoid some monitoring, external monitoring. That's all. Thank you very much. If you have any questions, let me see. How can I get I back here?
Yes.
Mauricio,
See?
I
Yeah.
have like two questions. The first one is how do you define if a family is controlled by a family firm? How can you establish that with the public data you are collecting for the paper?
Well, we state as family firm if the ownership concentration of families, the main shareholder is over 30%, I guess. In Chile and Colombia, it's easy to find the controller one, because I have the data of controllers. I've been working in some papers related to family firms in Chile. So I have clear evidence that who control the firm. But in these cases, I have to suppose some kinds of. I check the identity of the large shareholders, and I follow several processes. First, I download some reports of Brazilian companies to get if the main shareholder control the firms, and then I check some structure of the board of directors. I don't have the data of that, but I check. It's like a visual check to see if the controller one is who retain the control or take the main decision of the firm. Well, other things, I follow some criteria to get the identity of non-related shareholders by identifying the name and the relationship between family shareholders. I did that, This is because I know how to did the data procedure, This data, I've been working in that a few years ago, and I published a previous paper of contestability at fair value. So I use this data to perform this analysis. But I follow to get the identity of this shareholder. Mainly, I get some information of Aecon, web sources, also reports of the company. That's
In
all.
some way, uncollected information.
Yeah.
And the other thing was how are you? Sorry for this, but this could be like a naive question. But how are you defining financial constraints?
Financial constraints here are defined as investment cash flow sensitivity. There are some drawbacks to use these measures. There's some criticism in the use, but it's the most common way to compute financial constraint in the financial literature. There's another ways, cost of capital and I don't know, investment cash flow sensitivity to cash. But the most common way to compute financial constraint is this kind of measure. It's the most widely used.
In some way, this could be related with the level of indebtedness or the level of debt that the company can have.
Yeah, but in this paper we avoid this attrition problem by only consider surviving firms. When you perform this kind of analysis, you lead with with this problem of the which happens or what happens if firms are financially constrained and that in the period that you perform your analysis. But in this case, we only perform this analysis by using surviving firms.
Okay, but my question is because when you find a change in your results, when you have some control contestability, this could also be related with some preferences or the difference in the preferences between the controlling shareholder and the minority shareholders, because controlling shareholders always are looking for more debt and less dividend payments, while minority shareholders could be interested in less levels, so in lower level of debt and more dividend payments. So it's like an alternative explanation for your results. Maybe you can analyze that and to see if you can use it in the discussion of your results.
Okay, I will look for that. Thank you very much, Alexander. Nice to meet you.
Yes, Mauricio, I have a question. I don't know if anybody else have a question. Diego, Urbi, Nelson. All right. Well, my question is more related to the how to interpret the results. So when we have this family contestability, that is the presence of large family shareholders, there seems to be less financial constraints, right? I mean, when there is no family firms, then there is more financial constraint, and when is family, when you get the group of family firms, then there is a less financial constraint, if I understood correctly. So
when we take the group of family firms, the presence of multiple large shareholders increase financial constraints.
Exactly, increase financial constraints. So what is the intuition of this? I mean, why the market seems to the market thinks that they will collide, or I mean, what is the story behind that? Because I don't get it.
I guess the main story is that shareholders can collide if they don't have an agreement. The explicit agreement. If they don't have, they can collide. As an implicit agreement of control. This can be the main explanation, but I'm open to receive any suggestion.
Yes. This is what I thought, that probably the market sees like these firms, coordinating or something in order to extract some value from minority shareholders, for example. All right. So I think I understood. Very good. Very nice. So what is the next steps you are planning to do with this paper? What are you planning to? Because you said that you were been working with this paper for a while.
I guess to send it to a journal, improve the paper with the suggestion of the conference, and send it to a journal. I know that I have a lot of work to do that. I'm working in another papers too, but this is important because I like family firms.
Yes, me too.
And I don't in this time I don't have too much time to make research, because I have a position, but I have a legislative position, but I will try to improve the paper. This is the fact of this.
Yes, one of the things that you probably need to one of the things that you probably need to think about is also the endogeneity, right, issue, because what I think you are arguing is that this presence of large family firms as a large shareholder generates this contestability, and then it will affect the financial constraints. But it could be the other way around, like families get in firms because financial constraints. I don't know if you understand what I'm trying to say. So it's like the other way around. So maybe I have a family firm, so I invite, let's say, another family to join me because I'm financial constrained, or other way around. So I don't know how the endogeneity issue, which is common in all of our work in corporate finance, can affect this result you got.
Yeah, I was looking for an instrument, but I didn't find one. The only thing that I did in sometimes was incorporate AGMM estimations, and I performed, but not show in the paper, some kind of the N match, estimations to get some firms comparables to assess if these difference are related to some observable features.
Good, good. Well, very, 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 very nice. I think you have a very nice paper there. I hope it goes smoothly for the
Thank
next
you.
step. Yes. All right. So, well, the other paper didn't show up, so we can just finish for this session. This Rafael Scheuser and Theo Martin. So maybe we can, go outside and have outside, the virtual outside, and to the cafeteria